Question 3, Larry asks, I know that you can easily combine multiple super funds that are in accumulation mode, but can you do it for accounts that are in pension mode? For example, if you have or are planning to have more than one UniSuper Flexi Pensions in your name, providing separate pension income streams, can you at some point in time combine them all into one primary Flexi Pension in order to save on account fees? If so, what would be the necessary procedure required to achieve this outcome?
Yeah, okay, so let me take you through the key fundamentals here, and in particular, Larry, because you've referred to a particular product, I've just got to be careful with how I reply to you around that. I, of course, can't give you specific product advice, but I can give you, I think, enough factual information for you to then work out what needs to be done. So, number one, first of all, you are 100% correct. You can only ever have one accumulation account in each super fund. Now, you could have more than one super fund, creating the ability to hold multiple accumulation accounts. An example, I have a self-managed super fund and I also have an industry fund. I hold my insurance benefits through my industry fund because I find it more cost effective to do that. So I've got two funds. My SMSF has an accumulation account and my industry fund has an accumulation account. But the restriction I'm looking at here is you can only ever have one accumulation account per fund. You can, again, as you've mentioned, have multiple pension accounts or multiple pension interests in the same super fund, which is what you've ended up here, and you now want to sort of combine them. Now, in most all cases, in fact, in almost every case, you can't add further capital or further amounts to an existing pension. So if you've got pension one with $1 million and pension two with $1 million, if you put the $1 million from pension two into pension one, you've added to the value of it. You've added to the capital value of that pension, which you're not allowed to do. What would usually be required is for you to cease those different pension accounts. You would take that money essentially back to accumulation phase, and then you'd start a new larger pension with the combined balances or part thereof of those combined balances. Now, in your particular case, because it's UniSuper, they may have their own specific requirements. They may have their own specific processes that need to be used. So I would suggest contacting them and seeing how they can assist you personally with that. And what mechanisms or processes could be used to achieve the desired outcome you're looking for around combining those accounts. What's interesting is that I jumped on the UniSuper website and it says that once you start a Flexi Pension, you can't add money to it. So if you want to transfer extra funds to your super, do that before you apply. That's word for word from the UniSuper website. So again, to me, it suggests the same kind of process I mentioned before about stopping or commuting the existing pensions, going back to accumulation, and then recommencing a new pension. Now, let me add, if I can, some further comments here, which are relevant to you here around, I suppose, a particular question that you have, Larry, but also relevant for all types of funds, including self-managed funds. If you're considering doing something like this, so if you're considering combining multiple pension accounts, you would need to stop them and take those benefits back to accumulation phase. What the result of that is all you'll have one accumulation account, so all the taxable components of all those different pensions get mixed together, all the tax-free components get mixed together, so that you've then only got that one accumulation account with taxable and tax-free components. Now, it might have been over the years that you've put in place planning, estate planning or tax planning to keep those tax components separate for tax planning purposes or estate planning purposes. If you combine the pensions, that could unwind all those years of work, again, because you can only ever have that one accumulation account. So when you roll those pensions back, they do get blended. Second of all, make sure that you pay at least the minimum prorated pension before you stop any of them. Okay, and then once you recommence the new pension, make sure you pay the minimum on that pension. Otherwise, you'll miss out on the tax exemption on the earnings. So let's just say that Garth's got 3 pensions, and 1 July. Today, 14th of December, I decided to stop them. Make sure that the pro-rata payments from 1 July 2023 to today, the 14th of December, are paid on each of those pensions before I stop them. Otherwise, my fund won't get those tax-free earnings because I didn't pay the minimum pension. When I then recommence my pension, my new one larger pension today on the 14th of December, make sure that I pay my prorated minimum before 30 June next year. Again, just to ensure I get my tax-free earnings. The final point on this one is that if you cease those existing pensions, whether it be UniSuper, whether it be an SMSF or wherever, and then you start a new pension, think about your estate planning outcomes. Do you now need to put a new reversionary nomination on that pension? Do you now need to put a new death benefit nomination on any of your accounts? Because you have now changed those accounts that exist in the fund. So look, probably not doable unless you do the commutation, the ceasing back to accumulation and then recommencing. But I do highly recommend you contact UniSuper and ask them what their processes are that may be required.